Welcome to this masterclass for real estate investments, where we will be talking about open-ended real estate funds. As we recall from the previous sessions, we are building a real estate portfolio, diversified, and we are talking about funds. To recap, we have previously introduced closed-ended funds, and on this session we will be introducing the use of open-ended funds. Open-ended funds are funds that, or also known as non-traded real estate investment trust, non-traded REITs, allow redemptions, typically have a secondary market, provide both income and capital gains, and follow low-risk strategies. So the open-ended funds will typically help us to invest in core and core plus type of strategies. Also, we recall that the open-ended funds essentially track over quite extended period of times the performance of listed securities, listed real estate funds. And that's natural because they invest in the same type of assets. However, because the prices of the listed funds is dependent on the secondary market tradings and the available liquidity on the secondary market, over a short period of times, there will be divergences between the performance of listed and non-listed funds. So for the open-ended funds, being non-listed, tend to be suitable for investors who want a much smoother profile of returns, which is why people will typically invest in real estate. And finally, as part of this recap, I remember that open-ended funds have historically delivered returns substantially similar to closed-ended funds. So a portfolio that invests a large majority of its funds allocation to open-ended funds should not be particularly disadvantaged, even if it pursues a low-risk type of strategies. Now, when we go to open-ended funds, we find ourselves with a product which invests in non-liquid assets. So the vast majority of the assets is in physical, direct real estate. But at the same time, it offers the possibility of entering and exiting at regular interval. So how do open-ended funds manage this process of redemptions and subscriptions? So typically, these funds operate so-called entry queues to regulate the subscriptions. So let's assume that we have a quarterly dealing cycle, and we start receiving subscription requests. So in Q1, we receive the blue subscription request. So this typically will not be accepted until the fund has invested assets to deploy capital, because if it was accepted immediately, it will dilute the performance of the existing investors. And let's assume that this fund is having a very slow process of deploying liquidity. It typically takes, let's say, 1 year to deploy capital. So what will happen is that every quarter, a new batch of subscription request is added. So in Q2, we have the red queue. In Q3, we have a third, the green subscriptions. And in Q4, we have other investors, which we have identified with this black dot. So now let's assume we are in Q1 of the following year, and we have identified an asset to buy. So what we will do, we will go and call, the fund will go and call the investors who were first in the queue. So now they are entering into the fund, so they are exiting the queue. The same happens on Q2. Here, the fund is going to call the investors who were after the blue tag. So they had the red ticket and they are invested, and so forth. In the third quarter, the green investors will be called, and in the fourth quarter, the black investors will be called. So everybody will be invested by the fourth quarter of the following year. Similarly, when we have a redemption request, the fund, if the fund has spare liquidity, it can meet the redemption request straight away. But typically, these funds operate with extremely low level of liquidity because they want to be fully invested. So any liquidity that comes is typically from dividends, and it is distributed to the investors. There are some funds that maintain 5, 10%, 20% of liquid assets invested into REITs. These are typically the funds that goes for individual investors. In certain jurisdictions like France, where these funds are available to the general public, that liquidity may reach 50%, but at that point the fund loses its benefit of being a low volatility product, because with 50% invested in listed securities, clearly the volatility is going to be very, very high. So let's see how a typical institutional open-ended fund will handle redemptions. So let's assume we have received a redemption request in Q1, again is the blue line. The redemption will be put into a queue, and the fund will typically have 3, 4, sometimes even 8 quarters to meet that redemption. So the fund doesn't have to take any action. Okay. So in Q2, we receive another redemption request, which is added to the previous request. And the same in Q3, we receive another redemption request, which is then stuck on the previous 2 redemptions. Then assume also in Q4, we received the 4th redemption request. So we arrive at the end of the year and we have a number of redemptions. So the fund, what will do? The fund will take a moment and will start at that point, since there have not been any subscriptions in our scenario, the fund doesn't have the liquidity. So the fund has to sell some of the assets. So how do they sell? How the fund sells the assets? Well, he will put an ordinary, will tender, will make a tender, will start selling gradually properties, and use the proceeds to liquidate the redemption request in the same orders in which they arrived. So they first redeemed the blue code, then the red, then the green, and in this particular case, the 4th redemption request, which is the black, will be the last to be redeemed. Usually, these funds have an obligation to redeem their investors after 2 years, at least within 2 years. If by the 2nd year they still have not started the process of liquidation, the custodian might actually take over the fund and liquidate the entire fund. So the investment manager has an incentive in starting the process in a reasonable time frame. Now, what is important to understand in the open-ended funds is also the pricing mechanism. So at what price investors will redeem and subscribe. So there are typically 3 methodologies. The first is dual pricing. So let's assume we have a timeline and our values on an axis. So the NAV is our blue line. So this is basically the value of the properties. With the acquisition cost, the fund is able to calculate a green line, which will be our offer price. And then by adding the sales cost, the fund is able to calculate a redemption price. So we have an offer price, we have a bid price, and we have an NAV. So this type of funds on a regular basis will publish the three prices. Okay, one is the price at which investors will subscribe, and one is which is the green line, and one is the price at which investors will redeem. And the difference will be the acquisition cost or the sales cost. Acquisition cost in a fund, in a real estate, typically are the stamp duties or real estate transfer taxes. They use the cost of brokers, the agents, the cost of tax advisors. So all these are capitalized. So by operating this way, these funds are able to accept redemptions and subscriptions without damaging the existing investors, because the existing investors will have paid this acquisition cost. So if an investor were to be allowed to invest at the NAV, the existing investors will be diluted. Now, this is a type of pricing which might show up to 7, 8, 9% bid-offer spread, which is not very ideal for an investor, because investors will enter at the green price, and the next day, when they receive the bid price, they might have to use the bid price to value the portfolio. So they will show a 7%, 8% drop on the very first day. So the industry has come up with a different approach to pricing the funds, which is called the swinging price. So again, we have our NAV, which is the price, the value of the properties, and we introduce a concept of a liquidity buffer. So the fund will maintain some liquidity to manage the redemptions and the ongoing distributions. So in this particular example, I have shown the liquidity buffer as being at a certain level up to a point where it drops. So what happens? Typically, all investors will redeem and subscribe at the green price, as long as the liquidity buffer is above a certain level. So it could be 5%, it could be 10%. And this liquidity buffer is not cash. It typically is held in listed securities. However, at some point, the liquidity buffer drops. So what happened? There is a new price is introduced, which is this red line. So the price will swing. So what happens is that the investors will be able to redeem at the green line as long as the liquidity is high. If the liquidity drops, the fund will swing the price, and it will now accept redemption and subscriptions at the red line. Then the manager typically starts selling some properties, and the liquidity buffer increases, at which point the price swings again on the green line. So this swinging price, essentially what it does, it replicates what typically will happen on the listed market, okay, but driven by the internal liquidity of the fund. So you can imagine that the managers typically will be very, very careful in managing their liquidity, because these swings might be very painful. At the same time, for an investor that understands what is happening into these funds, it is very advantageous to enter when the fund is trading at the red line, because it enables the investor to enter, the new investor to enter at a price which is lower than the actual fair value. And the cost in this case is borne by the investors who decide to redeem. Finally, the third methodology which has been used, this is a little bit rarer, okay, is the one of the dilution adjustments. Here, what happens is that the fund will accept redemptions and subscriptions at the NAV, okay? However, if there is a large subscription, for that subscription, the fund will introduce a dilution adjustment and swing the price. So all the investors will continue to see the NAV as their reporting unit price, but for the new investor, the price at which it enters is going to be above the NAV, and that dilution adjustment is not a fee earned by the investment manager. It's just a charge which is kept by the fund to compensate the existing investors. Similarly, if we have a large redemption, the cost of selling a property to meet that large redemption can be debited to the redeeming investors. So what will happen is that the dilution adjustment will be applied to the NAV, and net redemption proceeds can be calculated. However, for the existing investors, the performance that will be published will continue to be the net asset value. Typically, this methodology works well for very mature funds where the acquisition cost have been amortized over the years. However, this is a rare approach. Now, in conclusion, what are the key takeaways for investing in open-ended funds or non-traded REITs? So what are the key takeaways of invested in open-ended funds as opposed to closed-ended funds? These funds provide access to lower risk strategies. They are less volatile than the listed securities, which are typically listed closed-ended funds. They provide access to existing portfolio of properties. Before investing, the investor knows exactly what is in the portfolio, and this is different from investing in a closed-ended fund, which is typically a blind pool. And finally, they can be liquid. They are liquid, and the liquidity depends on the size. Clearly, larger funds can accommodate, can maintain a certain level of cash reserves or listed securities reserves, and they can facilitate the redemption and subscriptions without an excessive entry or exit queue.